Hello everyone. In this video we are going to learn about concepts of the efficient market theory. We have already studied about efficient market theory. It says that stock market is an efficient market. The security prices in the efficient market reflect all the available information, making it difficult for traders to win over the market. This efficient market hypothesis or efficient market theory has certain concepts. In this video, let's see the different concepts of efficient market theory. A perfectly competitive market, which according to it operates in an efficient manner in order to bring about the actual stock prices with its present discounted value. This means that the equilibrium value of the stock determined by its demand and supply features represents the value of stock based on information that the investors have. Here, the present discounted value means the value the investors are willing to pay for the security which is available in the present. Here, the concept means stock market is perfectly competitive market where actual value meets the investor's expectation because the prices reflect all the available information. It is a perfect competitive market which reflects all the information in the security prices. If it further states that since the market is in its most efficient form, the participants in the market have free access to same information so that the market price which is prevailing reflect the stock's present value. Here all the investors get all kinds of information at the same time. So we can say that the stock market is unbiased or fair. If there is any deviation from equilibrium value, it is quickly corrected and stock find its way back to the equilibrium price. The analyst who is professional in trading of the stocks takes advantage of deviations and this forces the stock back to its equilibrium price. Equilibrium point is a point where demand and supply meets. We can say it is a point where the where both the company and the investors are satisfied, or we can say it is a price level which satisfies both the company and the investors. If the price varies from this equilibrium point, it will quickly returns back to this level. This happens because of the activities of professionals who are quick in taking advantage of this price variations. This theory also states that price change occurs in the value of the stock only because of certain changes which affect the company or stock market. It means the changes that is taking place in the economy which has impact on the company leads to changes in the security prices. The change in the price alters the stock prices immediately and the stock moves to a new equilibrium level. The equilibrium point, it is not constant point. It varies based on the changes that is taking place in demand or security for the demand on and supply for the security. Every time new changes occurs, equilibrium point varies and the stock price quickly moves back to this equilibrium level. This rapid shift to a new equilibrium level whenever new information is reflected is random walk theory. It means the quick response of the security price for the shift in the equilibrium level which is caused by new information, it is called random walk theory. It is called random walk theory because the changes is random, it is not specific. The instant adjustment is recognition of the fact that all information which is known is truly reflected in the price of the stock. Only if the price reflect all the information, it can lead to some changes in the security prices. Here, prices shows all an instant changes indicating that it is truly reflecting the new information. Further change in the price of stock will be only as a result of some other new information which has not available earlier. This process is constant but not the price. Every time new information arrives, this process recurs. According to this theory, the changes in price of stock shows independent behavior and are dependent on new piece of information that are received but within themselves are independent of each other. Changes in the security prices are independent means changes can occur to any extent but it is dependent on new information. It means prices will not change if there is no new information enters into the market. These are some of the concepts of efficient market hypothesis. Let's see it again. The market is perfectly competitive market. All the investors get all the kinds of information at the same time. Only experts can take advantage of the deviations. Price changes occurs because of the changes that is affecting the company. Equilibrium level varies. This variation is called random walk theory. Prices truly reflect all the new information that is taking place in the market. Further changes occurs due to further new information. These changes are independent but dependent on the new information. Random walk model and fundamental analysis. The random walk hypothesis is contrary to the technical analysis view of behavior of stock prices. It does not believe that the past historical prices have any indication to the future of stock prices. According to the technical analyst, history repeats itself and studying the past behavior of the stock prices, future prices can be predicted. The random walk hypothesis is in direct opposition to the analysis of the technical school of thought. There are two types of analysis which plays important role in taking investment decisions. They are technical analysis and fundamental analysis. Technical analysis believe that by studying the past prices, one can predict the future prices. Here, efficient market theory does not support this argument. The random walk hypothesis is in conjunction and to some extent believes in fundamental analysis. It believes that changes in information helps the superior analyst who has the capability of using inside information to outperform the investors of buy and hold strategy during the short runs. This is entirely possible because of some super analytical power like financial statement analysis or knowledge about inside factors which the public do not know. Therefore, random walk theory in its semi-strong form supports the fundamental school of thought. The random walk theories states that fundamental analysis which is superior in nature will definitely lead to superior profits. Random walk theory to some extent support fundamental analysis. Fundamental analysis is dependent on the intrinsic value of the stock. Here under fundamental analysis, investors uses financial data and insider information for predicting the future. There are some under semi-strong form of efficient market hypothesis. This semi-strong form of efficient market hypothesis does not consider the insider information. Therefore, investors can make profit by using insider information and superior analytical powers under semi-strong form of efficiency. The random walk theory does not discuss the long-term trends or how the level of prices are determined. It is a hypothesis which discusses only the short-term changes in prices and independence of successive price changes, and they believe that short-run changes are random about the intrinsic values of the security. The random walk theory therefore suggests that analysis should be able to look in for superior analysis of the firm by making following considerations. By using random walk theory, an analyst can try to make profit in the short run, for which he must be quick and efficient with his analytical skills. While analyzing, he has to keep certain points in his mind. They are as follows: finding out the risk and return characteristics of security. Before taking investment decision, an investor must analyze the risk and return pattern of the stock because it can affect his investment objective. Trying to combine the risk and return characteristics of securities into an adequate portfolio. An investor should create a portfolio based on his objective, that is, by combining risk and return characteristics of the stock. Holding a portfolio for a reasonable length of time and making continuous evaluation of securities held by him. An investor can make superior profits only if he holds a security or portfolio for a longer period of time. But he has to do a continuous evaluation of the stocks held by him. Planning a well diversified portfolio and by revising it if need be after consideration of after consistent evaluation. To be successful, an investor should diversify his portfolio and go for continuous revision based on the proper evaluation. By doing all these things, an investor can create a better portfolio and make profit in the short run. That is what random walk theory says. So we can say random walk theory does not consider technical analysis, but it considers fundamental analysis, specifically in the semi-strong form of efficiency. Technical analysis, it believes in the past prices and predicting future price on the basis of past prices. It is not supported by efficient market theory, but the fundamental analysis, which is based on intrinsic value and proper analysis, which is supported by efficient market theory. It is all about the concepts of random walk theory and the relationship between random walk theory and fundamental analysis. Thank you.